Assalamualaikum and hi, good day to you. My name is Azfar. I would like to present about what is the global financial crisis and its impacts to Malaysia. And as per my last presentation, I have mentioned about these three major economic crises in the world. Okay, let us recap from my last presentation. The three financial crises in the 21st century. Number one is 2001. On the year 2001 until 2002, Argentine economic crisis. Argentine economic crisis have been familiar feature since the Great Financial Panic of 1876. The country experienced its first crisis of the 31st century from 2001 until 2002, which involved the combination of currency crisis and a financial panic. So number two, what is a crisis? What is a global crisis in the 21st century? On 2007 until 2009, the world have facing this global financial crisis, widely considered the worst global economic crisis since the Great Depression. The global financial crisis in 2007 until 2009 ignited in the US and spread across most of the developed world. And number three, on 2014, there were Russian financial crisis, which this Russian leader has led the economy grew appreciably in the first half of the 21st century, thanks in large part to the thriving energy sector and rising global commodity prices. And so, what is the impact to our country, Malaysia? As you can see here, this chart, the real GDP grew only 0.1% year on year in the fourth quarter of 2008 compared to a 4.7% year on year growth in the third quarter of the same year. So, what are the effects that have occurred due to the global crisis? Number one is capital flows. Number two, portfolio flows, direct investment, foreign exchange rate, and the banking system. This type of effects I have mentioned in my last presentation. So, why the current crisis impact Malaysia? As you can see here, these are the charts of the trade channel. This data strongly suggests that Malaysia export structure is such that those goods export to developed countries are more important to the economy than other goods. It has been observed that the current crisis has had an impact on developing Asia through the contraction of trade and FDI inflows. It is easy to see why the current global crisis will impact Malaysia via the trade channel. Malaysia is a very open economy with exports and imports totaling 1.1 trillion, 2 times the national GDP. For a country that is as independent on trade as Malaysia, it is repercussions will be felt throughout the economy. The evidence for the extent of dependence on trade is striking when one notes the structure of Malaysia exports. This structure clearly indicates the dominance of manufactured goods, which accounts for about 82% of total exports, as per table. As you can see here, we have manufactured good, for electronics, which is the highest exports by sectors. There are electronic machinery and appliances, electrical machinery and appliances, chemicals and chemical products, textile, clothing and footwear, manufacturers of metal, optical and scientists, and so many more. So, there is no doubt that the export of manufactured goods is particularly vulnerable to drops in external demand, since the demand for electronics and electronics goods largely comes from developed countries, particularly the US, EU, and Japan. A decline in consumption in these economies is bound to have a negative impact on the exports of Malaysian manufactured goods. It is important to note that percentage share in the total exports has slipped the most from the previous year's percentage in 2008 in goods such as semiconductors 2.4% and electronic equipment 3.3%. The export of electronics, electrical machineries and appliances fell by 5.8% from 2007 to 2008. While manufactured goods accounted for 78.4% of total exports in 2007, it dropped to 74.1% in 2008. So, as we can see here, the vulnerability of Malaysian exports is also confirmed from an examination of trends in exports to Malaysia to its major trading partners. The US was the largest single destination for exports by Malaysia to its major trading partners. US was the largest single destination for exports in the mid-90s. However, it seems to have lost its favored position as other countries have come to take a place of roughly equal standing. In 1995, about 21% of exports were directed to the US, with a gentle decrease to about 18% in more recent years. So, if you can see at your right chart, the import sources, the percentage share, there is some convergence in terms of import sources. In the mid and late 90s, Japan was the largest import source, followed by the EU and Singapore, while 27% of exports were directed to Japan in 1995. This dropped to 13% in 2007. And further in 2008, 12.5%, the US accounted for about 16% of total imports between 1995 and 1997. In years 2007 and 2008, only 10% of imports were from the US. So about 11% of imports are currently from EU. The PRC was the source of only 2.2% of imports in 1995, but shot up to 10% only in 2005 and further to 12.9% in 2007. Okay, the next is the national policy response to the crisis. Government has announced the first economic stimulus package on 4 November 2008, which amounted to 7 billion. So what are these? They have 9 stimulus package. Okay, number 1 is 1.2 billion to build more low and medium cost houses. Number 2, 500 million to upgrade, repair and maintain police stations and living quarters and army camps and quarters. Number 3, 600 million for minor projects like village roads, community health halls and small bridges. 500 millions for public amenities such as roads, schools and hospitals. 500 million to build and improve roads in East Malaysia. 200 million for schools with equal parts going to religious schools, mission schools and Chinese and Tamil vernacular schools. 500 million to improve public transport in major cities. 1.5 billion to set up an investment fund to attract more private sector investment. Number 9 and the last, 400 million to expedite the execution of the high-speed broadband project. Okay, this 7 billion stimulus package, which accounted for approximately 1% of Malaysia's GDP, was criticized as too small. As the global economic conditions deteriorated into the fourth quarter of 2008 and early 2009, the Malaysian economy faced the prospect of a deep recession. The worse than expected global trade slowdown and the sharper plunge in trade in January 2009 prompted the government to introduce a second stimulus package that was bigger and more comprehensive, totaling 60 billion in March 2009. This package was almost 9% of Malaysia's GDP. Of this amount, 15 billion was in the form of physical injection, 25 billion for government guarantee of private loans and bonds, 10 billion for government investment company Khazanah Nasional to invest equity stakes in local projects with high multiplier effects, 7 billion for private finance initiatives and off-budget projects, and 3 billion in tax incentives. So it is a big amount. This is the largest stimulus package in the country's economic history and will be implemented over 2009 and 2010. The two packages together are equivalent to 10% of Malaysia's GDP. This makes Malaysia the second most aggressive in its policy-induced recovery programs among the Asian countries after Singapore. So the next is, what are these policy implications? And we can come to our conclusions. So this global financial crisis has hit Malaysia hardly, but in ways that are slightly different from the AFC. For Malaysia, it is an essential and export crisis, mainly manufactured exports, with direct impact on the real economy. The shocks in this crisis are transmitted through the financial and trade sectors. In the financial sector, the big impact was felt primarily in the stock markets, with rapid outflow of portfolio investments, sending the stock markets down by over 50%. But the fallout to other parts of the financial sector was limited, as the banking sector was sound and healthy, and there was no huge build-up of a property asset bubble. Also, Malaysian banks were not highly exposed to toxic financial assets. The major impact on Malaysia's economy came through trade channels. Like I said this before, Malaysia after the AFC became even more dependent on exports for growth. The collapse of external demand led in January 2009 to the biggest drop in exports to 28% the country has experienced since 1982. Okay, as you can see here, this chart show different impacts of the AFC. In the 2001 recession and the present global financial crisis on Malaysia's export performance. In AFC, exports actually climbed and lifted the economy out of the crisis. In the .com crisis, export declined slowly and moderated for 5 quarters before recovering. In the present crisis, exports plunged sharply for 2 quarters and picked up equally fast by the third quarter. Whether the rebound is sustainable is highly dependent on a strong recovery in G3 countries. So the second important feature of this crisis is that Malaysia, like most Asia countries, repaired its national, corporate and household balance sheets after the AFC and helped it absorb the shocks of this crisis relatively well. The country accumulated large foreign exchange reserve from running current account surpluses and not from capital account surpluses. This earned rather than borrowed reserves help the country cushion the impact of this crisis on its currency. In the corporate sector, leverage was reduced to manageable levels and hence did not lead to major defaults or threaten the banking system. Thirdly, the crisis exposed serious structural weakness in the Malaysian economy. Behind the rosy current account surplus story is the troubling decline in investments, which accounts for its positive savings investment gap. In other words, it's not a rise in savings but a drop in investment that led to the current account surplus. Total investment halved after the AFC and never recovered to its pre-crisis levels, led by the drop in private investment from 31.2% in 1995 to 10.9% in 2008, while public investment held relatively steady from 12.4% to 8.7% in the same period. Private investment fell not only because of the outlaw of direct investments by Malaysia company abroad, equally significant is the decline in foreign direct investments into Malaysia. In other countries such as Singapore and Korea, while domestic investment flow abroad, they also continue to attract substantial foreign direct investment in critical areas that accelerated the move up the technological ladder. Such is not the case in Malaysia. The reason for the drastic drop in private investments, both domestic and foreign, is the poor investment climate created by distortions and inefficiencies associated with the implementation of the country's new economic policy. New bureaucratic red tape and high level of corruption at all levels faced by investors and the public. Distrust over the impartiality of the judicial and police institutions, decline in the standards of education, shortage of skilled labor, lack of meritocracy in the public sector, and the continuous and increasing brain drain from Malaysia. Malaysia is stuck in the middle income track, losing its competitive edge as a low-cost producer to neighbors like Vietnam, Indonesia, and Thailand. At the same time, it is unable to climb up the technological ladder to become a high-end producer. This crisis has exposed serious structural flaws in the US and global economy as well as in Malaysia's economy. All countries, including Malaysia, have injected massive monetary and physical stimulus to their economies. The question is, have they addressed the structural weakness, or is it more or the same panacea? There is a little doubt that United States must readjust its saving investment gap. If, for example, reduce its current account deficits. As it seeks to do that, how will it impact on countries like Malaysia? And how will Malaysia respond? What are the options available to Malaysia? On the other hand, US readjustment will put pressure on Malaysian export to G3 countries and consequently lead to lower growth. On the other hand, a weaker dollar will not only hurt Malaysia's export but also affect the value of its dollar reserves. According to a World Bank economist, Malaysia has three options. The first is to accept the situation passively. Let me show you. The first is Malaysia has to accept the situation passively and adjust a lower growth trend that is led more by domestic demand. The second is to aggressively build on its comparative advantage in manufactured exports and become more competitive. Third, it can seek to climb the technological ladder and diversify into new products and services where it might have a niche or better productivity and export prospects. While Malaysia's domestic market can be strengthened with the right policies to increase productivity, return a significant portion of the productivity increase to labour by raising wages, and provide better social services and safety nets, it is still limited in size. Hence, export markets will remain an important driver of growth. Malaysia's massive physical stimulus package, equivalent to 10% of the country's GDP, do not address any of the major structural weaknesses identified earlier. They essentially substitute private spending with public spending. With leakages in the implementation process, the government under the new Prime Minister new Prime Minister at the time, Najib Razak, is trying to address the structural issues and in the process of producing a blueprint for Malaysia to achieve high income country status by 2020. So now it's 2021. So is it most of Malaysian people got high income in 2021? So it has taken a few initial steps to liberalize some restrictions and distortions associated with new economic policy, but burdened with a political base that has benefited so much from rent-seeking activities for decades. It remains to be seen whether there is enough political will to carry through any meaningful structural changes and removal of the barriers identified earlier. So, how about the current situation of the Malaysia from this pandemic COVID-19 for this global pandemic crisis? So, how about this year in 2021? What is your opinion, guys? So, for me, for this financial crisis, it is a lot of work to do. So I think government also have announced the new stimulus package for this lockdown 3.0. So guys, please stay at home. Thank you.